Okay, so welcome to today's webinar on the forecast cycle. Okay, we had a very popular webinar about the budget cycle, which we've done multiple times in the past 1 year. And a lot of people requested that why don't you also teach the forecast cycle, what happens during the forecast cycle end to end. So this is where this webinar is coming from requests from a lot of people who have attended previous webinars. So webinar, what we'll cover is our experience of working in the forecast cycle. So between Dhaval and me, we have about 2 decades of FP&A experience. We've been part of multiple forecast cycles, and we can share our experience of working in the forecast. First of all, before that, we'll just quickly introduce ourselves. So I have with me my partner and co-founder of FP&A Professional Institute, Dhaval. Why don't you go ahead and introduce yourself?
Hi, good evening, everyone. Welcome to this forecast cycle webinar. My name is Dhaval Parvatikar. I'm a qualified chartered accountant. I've also completed my 1 year executive management program from Indian Institute of Management, Ahmedabad. Over the last 15 years, I've served in various industries from oil and gas, software, advertising, and public relations, and also a global shared services of a commodity trading company. I've served as a CFO and a finance leader in India and Middle East. I'm currently based in Dubai. I'm now the co-founder and lead faculty at FP&A Professionals Institute. I've mentored thousands of chartered accountants and finance professionals through various initiatives on LinkedIn, like one-to-one calls, articles, posts, and much more. And I also been an online instructor over the last 5 years. I've trained more than 5,000 professionals on various topics related to FP&A, data storytelling, business partnering, leadership, CFO coaching, and much more. So I'm excited to be here and partner with Asif. One thing about Asif and me is that we both share the same interest of being extremely excited about helping finance professionals upskill themselves in their careers. And that's what brings us together and keeps us going regularly. Yeah. So over to you, Asif.
Amazing. Thank you so much, Dhaval, for joining me. And absolutely, we'll hope this session goes as well we have planned. So what we'll do is I'll quickly introduce myself as well. So for those of you who don't know me or seeing me for the first time, my name is Asif, and I have been working in FP&A for over a decade across multiple industries. So I have work experience in FP&A across Citi, Pfizer, Coursera. Those were the three companies I've spent maximum amount of time during those 10 years. And today, what we are going to do is we're going to share all the forecasting experience coming from those companies that we've gathered together in this presentation. I am the co-founder and lead faculty at FPI along with Dhaval and a regular contributor. I've written a couple of books on FP&A, which is one of them especially has been on the management accounting bestsellers list on Amazon for a while, which is all about FP&A. And the next one is the one that got published recently, the 6 months back, was from accounting to FP&A. So that's a little bit about myself. What I'll do is I'll also quickly introduce FP&A Professionals Institute, which has been our, our project for, we've been working on this for the past, I think, 3 to 4 years, even before it became an institute. So it was known as a FP&A Professionals blog when it started back in 2021, 2022. And over time, it evolved and it became institute. So quickly in a minute, I'll just cover FPI's journey. So back in 2018, Dhaval started his first online course, which was FP&A Foundations. And over the period of last 6 years now, I think 7 years, more than 2,000 students have taken that program, and it has a very good rating on Udemy. In 2022, I came up with my first book. This was published in 2022. Although I was writing this book for a while, I started writing this book in 2020 end or maybe 2021 beginning. So it took me about good 12 to 18 months to get this published. And it has sold more than 3,000 copies by now and has been on the Amazon bestsellers list for management accounting for multiple months. Then that's when we got together. So after looking at, after people coming and reading my books, a lot of people requested for live trainings. And I had already gone through Dhaval's program, so I thought it will be best to reach out to Dhaval, and Dhaval was kind enough to partner with me, and that's how the FP&A masterclass started back in 2022. Happy to share that we've completed more than 15, I think 16 now. The number is not updated, and over 450 students have successfully completed the FP&A masterclass, which is a 4-week intermediate program in FP&A. Okay, I'll not go through all the details, but we did multiple programs in 2023. 2023 is when I had quit my full-time role at Coursera as an FP&A lead for APAC, and we went into this full-time. And then I started more programs on financial modeling. Uh, and then 2024, we launched our second book along with our 6-month in-depth certification on FP&A, which is Certified Global FP&A Professional, which is an advanced level certification in FP&A. We launched multiple other courses as well during 2024, which has been more around AI and the tools related to FP&A. So this is a little bit about FP&A. Over the last 4 years, we've trained more than 3,500 students under the FPI or the FP&A Professionals banner, which became FP&A Professional Institute somewhere in between 2023 and 2024. So with that background, what I'll do is I'll just quickly cover what is going to be the roadmap for today's session. So we are going to cover the forecast cycle as we had promised. So what we'll do is before getting into the details of the forecast cycle, we'll quickly cover what is forecasting and why is forecasting important for those of you not from the FP&A background. So for those of you who you are, please bear with us for the first 5 to 7 minutes. We'll just quickly cover the basics and then get into the forecast cycle. Okay. Then we get into the forecast cycle, which is a framework which we have come up with after looking at probably more than 5 to 7 different forecast cycles across different companies. And it might not be exactly the same in every company, but you would find you might find this to be a good representation for most of the companies that you have worked with. So this is going to be a 3-step framework where we will cover the different steps in the forecasting process, right from doing the preliminary update to the forecast, getting it reviewed from different levels, and then finally consolidating it and uploading it in the system. So we'll talk about each of these stages in detail during the session today. A little bit about the background about FP&A and how is forecasting related to all the other activities we see in the FP&A profile. So for that, I'll pass it on to Dhaval.
So cool. So when it comes to FP&A, right, there could be dozens of activities which are carried out by FP&A teams, and all of them can be clubbed into 3 broad groups. One is budgeting, forecasting, and under management commentaries, you have variance analysis and profitability analysis. Now, budgeting is all about, now we'll be focusing on forecasting in today's session, so we'll just quickly touch upon the others. Budgeting is all about creating your annual business plan for the upcoming financial year. The end outcome like a P&L statement where you have your estimated revenue, your different set of costs, and your operating profits. Budgets are created before the start of the financial year, and once they are approved by the board and uploaded in the system, they are frozen. They are not changed every now and then. Then comes forecasting. Forecasting is more of a regular check on the performance of the business. You can do it on a monthly basis or on a quarterly basis, and we'll understand a little bit about more about forecasting as and when we progress in this training. Sorry. The third bucket is the management commentaries bit, where at every month you will do different kind of comparisons: actual versus budget, actual versus forecast, current month versus previous month, current quarter versus previous quarter, year to date current year versus year to date last year. All of these different kind of comparisons, and come up with reasons for variances. And these reasons for variances are captured in management commentaries, and these commentaries are usually business oriented. Right? Why is there a decline in revenue? It could be because of a competitor coming up with a discount scheme that hijacked our sales. Yeah. So that is a business reason. So management is looking for business reasons in their commentaries. Companies also engage in different types of profitability analysis. If a company is structured business unit wise, then the CEO, CFO might want to see business unit wise profitability. If the company is structured branch wise, then they might want to see branch wise profitability. Similarly, client wise profitability, customer level, wholesaler or distributor level, regional level. Depending on how the company is structured and the complexity of the organization, different types of profitability analysis are prepared, and they are included in the management reports or management commentaries that you're submitting on a monthly basis. So this is the broad set of activities that are that are involved in FP&A. Not an exhaustive list, but I would say there's a 90% chance that you will come across all these 4 activities in every company that you will work with. Yeah. So now let's move on to understand a little bit more about the second bucket, that is forecasting. What is forecasting? Why is it done? All of those things we'll try and understand a little bit now. Budgets, as we know, represents the plan for the financial year. It is a target for the financial year. It serves like a blueprint. Right? What is the estimated revenue that we want to achieve? What are the different set of costs? And what is the operating profit? And the frequency of preparing a budget is usually annual. Typically, let's say if you are following a calendar year financial year, then the budget preparation activity starts somewhere in September or August and goes on with multiple variations and multiple versions of it. The budget gets finalized in December, which is then approved by the board and then gets uploaded in the system. So that is how the budgeting cycle goes. And it's usually an annual exercise and done once a year. Forecasts, on the contrary, are about tracking the performance of the business on a regular basis at regular intervals. So companies like to follow either a monthly or a quarterly forecasting, depending on how the business is and the fluidity of the business. So it is basically you're tracking the actuals for the completed months. For example, let's say in the calendar year, if I have Jan to March as actuals, then I'm taking Jan to March as actuals plus 9 months of estimates. And the frequency of it will be either monthly or a quarterly basis, depending on the complexity of your business, right? So that is the difference between a budget and a forecast. So let us move to the next slide and understand the difference between a budget and a forecast with an example. The top table that you see represents budget for 2023, financial year 2023. And assume that you are at the end of 2022. So when you are preparing a budget for the next financial year, that financial year has not even started. You are at the end of 2022. And you can see that the budget, it's a simplified budget where you can see revenue, costs, and profits. And you can see that the total revenue is $1.35 million and a profitability of 12%. That's the top table that you are seeing. Now we move to January end. At the end of January, you have the actual numbers for January, and you can notice that the sales target is missed by $10,000, although the profitability is maintained at 12%. Now, at the end of January, during my forecasting exercise, I will go back and recheck my assumptions that were during the budget. I will take another round of estimate from February to December and check or the assumptions that I had during my budgeting exercise still hold good or no. In this example, they still hold good. That's why you will see the numbers are the same from budget for February to December, although the representation has now changed from BUD, which is budget, to FOR, that is forecast, right? So you can notice that. And this way, I'm taking my forecast numbers from February to December. And now at the end of, at the end of January, I can notice that my forecasted revenue is 1.34 million, as opposed to my budgeted revenue was 1.35. Now, a question might be running in your mind, why can't we call it revised budget? No, budget is a one-time activity. You don't change budgets because there are a certain level of approvals, board approvals and everything that go in their system. And you want to know that what was the assumption that was at the beginning of the year? Does it still hold good during the financial year? So that's why the budget number is not touched again. On a regular basis, you will keep updating your forecast. In this case, you have looked at a Jan forecast. Now let's look at one more example. Asif, is there one more slide on this? So here, the top table on the budget that you see is exactly the same what you saw on the previous slide. The budget has not undergone any change. But now we are at the end of Q1. We have actuals for Jan, Feb, and March. Now you will notice that February and March have been great months for us. We have beaten the budget by $10,000 and $15,000 respectively for February and March. And Q1 has been amazing. So at the end of March, at the end of Q1, I will go back and check again whether the assumptions for my previous forecast or my budget still hold good. And then accordingly, I'll update my April to December numbers. In this example that you see on the screen, the assumptions are still good. But nobody's stopping me from putting April as 105, May as 107. I can do that. That is the main reason of why you are updating a forecast. Because I want latest information, latest assumption. A forecast reflects the most latest market condition. I hope you're now able to appreciate the difference between a budget and a forecast. A budget is an estimate which is taken even before the start of the financial year, whereas a forecast is a regular check that is kept on a monthly or a quarterly basis to understand the performance of the business, to help the management know that whether you are on track, are you meeting the numbers. So in this example, you will now say the Q1 forecasted revenue is $1.365 million. Budgeted revenue still remains 1.35, but the forecasted revenue is $1.365 million. Maybe by the time I reach June, this may become 1.4 or 1.2, depending on the market condition at that time. But as at the end of March 2023, I know that I am estimating to cross $1.365 million as my yearly forecasted revenue. I hope you are able to distinguish and appreciate the difference between the budget and the forecast. Moving on.
Before we go to the next slide, I just wanted to introduce one concept. Okay, so how do you read this table? So when I go to the previous slide, here when you update 1 month of actuals, you call this as 11, or you call this as 11 months of forecast and 1 month of actual. So what do you call this as is 1 month of actuals plus 11 months of forecast. So when you call this forecast, the version this forecast is, okay, or if you have to give this forecast a name, it will be called as 1 plus 11, meaning 1 month of actuals and 11 months of forecast. When you go to February and when you actualize February, when you have actuals for February, it will become 2 plus 10, meaning 2 months of actuals and and remaining 10 months of forecast. And in the next slide, when we saw first quarter actuals, this will be then 3 plus 9, which is 3 months of actuals and then 9 months of forecast. So whenever you update one version of the forecast, you change the name for it and you give it another name so that you can easily compare the forecast, which was 9 plus 3 versus the forecast, which was the previous forecast, which is in this case, this is 3 plus 9 and the previous forecast was 2 plus 10, right? So you should be able to compare between the two versions, and that is why you're giving it names or different version names while you are going and updating the next version of the forecast. With that, we'll get into the why of forecasting, right? Why is forecasting important?
So why forecasting is important? Again, there are four primary reasons. One is that it helps you understand the direction of the business. Are you meeting your revenue numbers? Are you up or are you down? If you're down, then what is the reason? Are there any course corrections that you need to take? Do we need to change the pricing? Do we need to introduce some more discounts? Whatever is your course correction that you can engage with if you understand where you're heading and what direction you're heading in the business. The second one is spending course correction. Now, let's say during the time of budgeting exercise, let's say we are a 1,000 people company and we have planned to hire 100 more people in the financial year, and that is what we have budgeted for. But by the time you reach Q1 forecast, you're noticing that the business is not going as expected. Some of the products are not doing that well as you had expected. So then the question is, do we really need 100 people to be hired in this financial year, or should we tone it down to 80 people? Should we rephase them? Maybe we can hire more people in Q4, maybe lesser people in Q2, right? To give it a little bit more time to see and understand whether the market is working for us or not. All these kind of spending course corrections are possible during the forecasting exercise. Sales course correction is possible. Again, let's say your product A does not do well. Then you can shift focus to product B, product C, right? Or shift focus to market A, market B. All these kind of sales course corrections are possible if you understand the forecast, if you understand the direction in which the business is heading. Better cash flow planning. Some businesses are seasonal businesses. They generate more cash flow in the peak season and generate less cash flow in the off season. So better forecasting will help you to manage this cash flow, even out the kind of peaks and dips, and then manage that cash flow in a much better way, so that it will allow you to manage your expenses, manage your hiring, manage your credit facilities. All of those things will be possible with right set of forecasts.
Okay, with that right understanding of the what is forecasting and why is it important, we'll take a quick pause and see if there are any questions. So if there are any questions till this at this point, feel free to drop it in the chat box and we'll be happy to take them. While you do that, I'll just quickly cover how does a typical FP&A calendar look like, or how does a typical FP&A monthly calendar look like, and where does forecasting actually fit into that. Okay, so we talked about what is forecasting, why it is important, but let's understand where exactly does it fit in your FP&A monthly calendar. Okay, so typically, how we have structured this is your week one is your first week of the month, which you can consider is, say, for example, you're talking about next month is February, right? So if you're talking about February month, The first week of the month of February would be the first of the month to the seventh of the month. Okay, and the week would be 8 to the 14th or 8 to the 15th, and then so on and so forth. Okay, so what typically happens usually in most companies in the first week of the FP&A month is that you focus on your flash reporting till the time your books of accounts are closed. So books of accounts are not usually closed till the first few days. Maybe it might take 3 days for some companies. It might take 7 days for some. So it usually isn't closed on the first day of the month. It takes a few days to a week. So till the time accounts are closed, FP&A teams will usually give the best estimate of the month's number, previous month's number. In this case, we are talking about January's number. So you are in the first week of February and you're giving the best estimates of the February revenues and February expenses even before those numbers are ready with the accounting team. Okay, so it might happen for the first few days, and then once the accounts are available, when the books of accounts are closed by the controller team or the accounting team. So FP&A team usually won't get involved in the closure of the books. They might only get involved in the review once the books of accounts are closed. Say it gets closed on the fifth day of the month, they will then get on a meeting or get on a call, Zoom call with the accounting team, review the numbers, understand how they are different or what is the difference between the flash they had reported earlier and the actual account, I mean, actual closed numbers or the actual final numbers for the month. Okay, they'll understand what the difference is and they'll try to uh, put some commentaries for the senior management to explain them, okay, what was the change happened between the, if there is a big material change that has happened between the flash and the accounting close. Okay, so that is typically what usually happens when the accounting close is done. And then once the previous month numbers are available, then you start preparing, or in case if you already have a management reporting framework set up, you start updating those management reports for distributing it to different business teams. Okay, so you might be working in an FP&A team where you might be preparing various reports. You might be preparing a report for sales team, for marketing team, for HR. Different teams might require different management reports on monthly basis. So after the accounts are closed, you now have the final numbers. You can then prepare the management reports for the previous month. This is how typically week one looks like, and then comes the forecasting week, which is the second week, which is what we will take a look in detail in this session going forward. So hold on for this one. So week two is when the most of the companies do the forecast. Again, it might not be in case of every company. It all depends on when the books of accounts are closed. So if the companies are closing the books of accounts in week two, then probably the forecast might happen later, might happen in week three. Okay, but in most companies, their aim is to close the books as soon as possible, maybe in the first 3 to 5 days, and then update the forecast as soon as possible, right? So that is when the forecasting happens, at the end of week one or in week two. Okay, I'll not get into the details of the monthly calendar, but wanted to share like where the forecasting happens in the month most companies. Okay, week three is again once you're done with reporting, once you're done with forecasting, you are more doing of additional analysis. So a lot of teams may want to spend time doing some additional analysis which they could not do in week one and week two. They might be working on ad hoc projects. They might be working on automation that can help them fast track their week one, week two, and week four in the next months going forward. Okay. Another thing FP&A teams might do is they may want to just check the last updated forecast on the risk and opportunities. Okay. Again, we'll talk about this when we talk about the forecast cycle. So after the forecast is submitted or updated, it's not that it's over, that you don't have to keep a track of it. You might be doing something called as risk and opportunity analysis, which we'll talk about in detail when we come to the forecast cycle. So this is typically the week three, and then week four is more of preparation for week one. Again, you start doing the flash reporting from say the 28th of the month, and you continue doing that till the third or fourth of the month, till the time your actual numbers are available. Yeah. Typically, this is how the FP&A calendar looks like in most companies, and forecasting is a big part of it. It usually takes up anywhere between 3 to 4 days to update a forecast if you're doing it on a monthly basis. Some companies do it on a quarterly basis. In that case, you will only see this happening once in a quarter. So you might not see this happening every month. You might see this happening every quarter if the company is updating the forecast on a quarterly basis. Okay, so let me just take a look at the comment. Okay, so there's a question, will you change the forecast amounts to be different than the budget as the forecast goes on? For example, will you change April budget revenue, cost, profit, or do you need to keep them at the original budget? So the budget number will not change. So there will be two different points of uh, comparison that you will have. So the budget number will not change, but you will make the change in the forecast so that when you compare budget versus forecast, you will know what has changed from the budget. Okay, whatever. So you might want to make that update in the forecast. The budget will not get updated. The forecast will get updated. So that is, hopefully that answers the question. So this is how typical FP&A calendar looks like, and forecasting is a big part of it, and usually happens at the end of week one, sometimes week two. And if the company is really late in closing the books, might happen in week three. But it's usually between the closing of the books and you preparing the management reports and you doing the ad hoc analysis, right? So it happens somewhere in the between. Okay, so what we'll do is we'll now get into the forecast cycle, which is the main part of this presentation. Before that, a couple of quick questions that we usually get when we are talking about forecast. So let me ask this to you, Dhaval. What is the difference between a forecast and a rolling forecast? A very popular question that we keep getting asked on a very frequent basis.
Sure, I think this is one of the most frequently asked questions that we always get. Are forecast and rolling forecast the same? What is the difference? Should a company engage into a forecast or should a company engage into a rolling forecast? All these are questions that always crop up in our minds. And of course, these are some of the questions that might confuse the candidates in the interview as well. So that's why I think it is important for us to touch upon this question and fully explain the difference. Maybe we can look at it with an example which is available on the next slide. The top forecast table that you see was the same forecast table that you saw a few slides ago, right? We had Jan to March of actuals and April to December of forecast. And 1.365 million was the forecasted revenue at the end of Q1 of 2023. Below table that you see is a rolling forecast. Now, how is it different? Here, we have not only taken a forecasted number from April to December, but we have also added a Jan to March next quarter as well, which means I am now looking at my rolling 12 months. By the time I reach June, I'll have Jan to June of actuals and July to next June of my forecasted numbers. So at any given point in time, I will have a 12-month visibility. Okay, I'll have a rolling forecast available for the next 12 months. That is the classical, I would say, authentic meaning of rolling forecast. But however, the strange part is that many companies, okay, even the companies that I have worked with and the companies that I have come across, right, they call the traditional forecast that you see on table 1 as rolling forecast. Sometimes companies use this term forecast and rolling forecast interchangeably. But the technical definition is that you're looking at a rolling 12 months. So if I'm looking at my forecast in September, let's say I have Jan to September of actuals, and October to next September is my rolling forecast. Okay, so I don't stop myself at the end of the financial year, but in fact, I go for the periods beyond the financial year as well to see what is my rolling 12 months forecast. That is the technical definition of rolling forecast. Okay, so I hope everybody is able to appreciate the difference between the forecast and the rolling forecast. Now, a quick question for you guys. So when we reach December, what happens? We have Jan to December of actual numbers. Can we prepare rolling forecast for the next financial year, that is Jan to December? The answer is a yes. Then the question might be, does that eliminate the budgeting exercise? Because at the end of December, anyhow, we are preparing a 12-month rolling forecast for Jan to next December. Does that completely eliminate the need for a budget? It does not eliminate the need for a budget, but many companies just use the rolling forecast that they are preparing at the end of December for Jan to December of let's say next financial year. They just use that number as the budget, get it approved as a budget, and that remains as a budget for the financial year. So it does not completely eliminate the exercise of budgeting, but however, companies who have implemented rolling forecast appropriately, they don't necessarily need a budget. Rolling forecast will do the job for them. I hope that answers the question. So I hope you are now able to appreciate the difference between a budget, a forecast, and a rolling forecast.
And the second question which we usually get after that is, should we prepare the forecast on a monthly or a quarterly basis? So we looked at two examples, right? One was a monthly forecast and one was the quarterly forecast. So what should we do?
Sure. Again, a super popular question that we always get asked. What should companies do? If you are the CFO of the company, would you prefer to see a monthly forecast or a quarterly forecast? The answer lies in the kind of fluidity and complexity that is there in your business. If your business is pretty complex, more market reactive, it is more fluid, then you should look to do a monthly forecast because the assumptions may undergo a change over a period of 30 days. But if you're in a very classic, stable, boring kind of a business, right, then a quarterly forecast will be sufficient. When I was working with an oil and gas company, an oil and gas, not an extraction, but a refining company, which the main products are petrol, diesel, and the industrial fuels, right? There we had a quarterly forecast because nothing major happens in an oil and gas sector over 3 months. 3 months is like a very short period. To set up a refinery, it probably takes 3 to 4 years, right? So 3 months is nothing. So there, a quarterly forecast would be sufficient. As opposed to that, when I was working with an advertising company, uh, on a couple of occasions, I even introduced a concept called mid-month forecast, where every 15 days I wanted to look at the forecast because the client budgets were changing so fast. Basis the client budgets, our commission revenue will change. There was so much fluidity in the business. So if you are in a fluid and complex business, then go for a monthly forecast or even a fortnightly, depending on the kind of complexity you are in. Monthly should be good enough. If you are in a stable, boring, classic kind of a business, then a quarterly forecast should be good enough.
Yeah, yeah. So even in my experience, when I worked for the banking and the manufacturing companies, those were both very stable. Not a lot was changing in terms of the assumptions over a period of quarters. So we used to do quarterly forecasts. But when I moved to edtech companies, which are usually more dynamic and a lot of things change very fast compared to traditional businesses, there we were doing the monthly forecast because assumptions were changing very constantly or on a monthly basis. So that hopefully that answers that question. What we'll do is with that we'll get into the forecast cycle, the three steps that we talked about, right? The first step is you update the preliminary forecast, right? You make the preliminary update. What happens during this stage is you as an FP&A person, you will take the previous month forecast numbers. Okay, so say for example, you are in the month of say just hypothetically say you are in the month of March, okay, and you have the March actuals now. Okay, so what you will do is you will take the previous version of the forecast, which will be Jan February actuals, and it will be forecast for the months of March to December, right? It is called as a 2 plus 10 forecast, meaning 2 months of actuals and the you have 10 months of forecast. That is your previous month's forecast numbers, right? So you'll pick that version up and then you will actualize the month of March. Okay. So now that you have the March actuals, you are in the first week of April or maybe end of March, you have your March actuals. So the first step when you do update the forecast is you pick the previous version of the forecast. In this example, you pick up the 2 plus 10 version, which is 2 months of actuals, 10 months of forecast, and you make it 3 plus 9. What you do is you actualize the month of March, you update the March forecast, which was the previous month's up forecast with the March actuals. So now what you have is 3 months of actuals and then 9 months of forecast. And you will also update the remaining 9 months forecast assumptions so that you get to a updated forecast for this cycle. Okay. So that is what happens in the preliminary forecast update. It is done by the FP&A team. So you as an FP&A analyst will take the previous month's forecast number, actualize the current month actuals. In this example, it was March, and then update the assumptions for the remaining 9 months. When you do that, you will automatically get a different version or a newer version from the previous version, right? The previous version was 2 plus 10. Now you have a 3 plus 9, which is going to be a different version compared to the previous version because one, you have updated the actuals for March, and second, you have also updated some of the assumptions which you know are going to change or have changed from the previous month. Okay, so in this step, you are not interacting with anybody else in the company, right? You're doing this on your own, and you're sitting on your computer and you're looking at the previous Excel file. You're just rolling it forward to the next month and updating the actuals and then doing the preliminary updates on your own. So this is what happens during the first stage where you are yourself updating the preliminary forecast for the next version. Usually it will happen immediately after the actuals are available. So in that calendar, when we saw that, right, it was end of week one. So typically you will just immediately after the actuals are available, you will actualize the next month if you're doing a monthly forecast update, and then you'll start updating the assumptions for the remaining outer months. Okay, in that our example, it was outer months were April to December. Okay. What happens after you update the forecast assumptions, which is the preliminary forecast update is done? You get it reviewed, right? And there are multiple levels of review depending on the structure of your organization and the structure of your finance team. Okay, so if it's a very big organization, there might be multiple layers of review. Your FP&A, if you are an FP&A analyst, the FP&A manager will review it. Then the FP&A director may want to review it. Then CFO may want to review it. Okay, so there might be multiple levels of review inside the finance team that might happen during that second week of the calendar that we saw. If it's a very big organization and the FP&A team is huge, okay. If it's a small organization, it's only two people there are there in the finance team, then there will be less number of reviews, or there might be no reviews. You might be just talking and going for the next stage. So what happens during the next stage is the forecast reviews. Is you get your forecast reviewed with different levels or different people in the organization. So first level of review happens with your boss, which might be the FP&A manager or FP&A director, assuming that you are an FP&A analyst. Okay. So your boss, who is the FP&A director, manager, they will review the forecast. They might give you certain inputs. Based on those inputs, you may want to make certain adjustments to your assumptions for the remaining 9 months in our example, right? We are looking at the April to December forecast. So you'll go back to your forecast version that you had updated in the preliminary forecast. You will make those changes based on the review, okay? Because they might know certain changes that might have happened in the assumptions, which you may not be aware of. Okay, that is a first level of review that happens. Now, once the manager or your director reviews it, you will also get it reviewed from the business side. Okay, business side meaning if you are doing a marketing forecast, you will get it reviewed from somebody who's on the marketing team. Okay, it might be the marketing manager, it might be the marketing director, whoever that person they have designated as the reviewer of the forecast. You will get the forecast reviewed from the business side, meaning if you're doing for the marketing team, it'll be marketing team. If you're doing for the sales, it might be sales. Depending on which area you are working, you will get that reviewed from the business side or from the functional teams. Okay, in case of headcount forecast or salary forecast, it might be the HR team. Second review that happens is with the business teams. Okay, once they review it, they may give you certain more inputs or they may give you certain more changes that you may have to make. Okay, because they are more closer to the business compared to you. They might tell you, okay, you made this change, but okay, this is another thing that you should keep in mind. Okay, you should also incorporate this in your forecast because this is just what we figured out day before yesterday. Okay, which you were not aware of. This was after the last weekly meeting that we did. Okay, so they will give you more closer numbers or they'll give you more closer assumptions. Okay, so again, you will update those. Okay, so second level of review happened, right? You now got your forecast reviewed from first, you got it reviewed from your manager or director. Then you got it reviewed from the business team, which is the business partner on your in case of in your case, it is your stakeholder. Okay. Now the third level of review will happen with the CFO and the CEO. Okay. Now once your manager is reviewed, once the business team has reviewed, then it might be the CFO and the CEO who may want to just quickly take a look at the final version before it is locked and it is going to go into the system. Okay, so maybe in most cases CEO may not look at it, but at least the CFO will look at it. In bigger companies, CEO will not usually get involved. It will be the CFO who will just look at the final review, and he might also give you certain changes, or he might also have certain assumptions that he may want to add in, or he may want to make some changes. So again, you will update those, and then after usually these three levels of reviews are done, the manager level review, the business side review, and the CFO review, then you will lock this version. Okay, you will say, okay, this is the now my final version of the 3+9 forecast, and then you will upload it into the your ERP or your budgeting tool, whatever the tool you are using to consolidate or to track your budget and the forecast numbers. Okay. If you're already using, if you're already updating everything in the tool, you may not have to upload it. It might already, all these changes might already be happening in the tool. But if you are making these changes in Excel, you might have to update or upload it into the tool. So this is usually what happens, right? The preliminary forecast updates, then you get it reviewed at different levels, and then finally you consolidate it. So if it's a big organization and then there are different business units, then in that case, one person might be doing the forecast for one particular business unit. Okay, another person might be doing the forecast for another business unit. Okay, so then there is a consolidation team or a corporate FP&A team who will consolidate all the forecast, and it will get consolidated in the budgeting tool or the forecast tool, and then it will be uploaded and locked in the system. Okay. So all these activities, right, the preliminary forecast updates, the different levels of reviews, consolidation, system upload and lock, all of this happens during the second week in most companies that we had seen in the budgeting calendar. Okay. So this is how typically a forecast cycle looks like. So just quickly recap it. Preliminary forecast updates where you will yourself as a FP&A analyst go ahead, pick up the previous version of the forecast, actualize the previous month, then uh, review the assumptions for the remaining months. Okay, so this is you doing all the updates on your computer based on whatever your experience is. Then you get it reviewed from different people in the company, right? From your manager, who's going to be FP&A manager, FP&A director. Then the business side, okay, it might be the marketing manager, it might be the sales head. Okay, then the CFO. So different people will review and give their inputs. Once all the inputs are incorporated, you will then say that okay, this is the final version of this particular month, and then you will consolidate. I mean, the corporate team will consolidate it, and it will be uploaded in the system. So typically, this is how the forecasting process looks like, and all of this happens during typically a period between anywhere between, for smaller companies it might be 2 to 3 days. For larger companies, it might take maybe 5 to 6 days, okay. Depending on how much big the organization is and how what is the level of automation, it might range anywhere between 2 to 6 days. The forecast entire forecast cycle. Okay, so that was the forecast cycle we wanted to share. Before we go to the next step, wanted to take a quick pause again, see if there are any questions. You can type your questions in the chat box or you can raise your hand. Either ways. While you do that, we'll just get you started and we'll take a couple of questions that we usually get asked when the forecast cycle is discussed.
Great. So one of the questions that we kind of always get asked is, what happens after the forecast is locked? I mean, is there any change? Can we edit it? What is the kind of process? Asif, you want to throw some light on this?
Yes. So see, once you've decided that the forecast is locked, right? So once you've decided, okay, this is now, today is second, say the second week of February, and today is 12th of February, and your CFO review is done, and your CFO says, okay, lock this, upload it in the system. Any change that happens after the lock is done and upload is done in the system, say you did that upload on 12th of February, and something changes on 13th of February, right? You will not go and make that change in the uh, in the version which is the 3+9 version which you had just updated it. All the changes happening after the 12th of the month, that is why that cutoff is important. All the changes happening after that will be, you will have to keep a track of it for updating it in the next version of the forecast, which will happen same time next month. Okay, so any changes usually that happens after the forecast is stopped, they will get accumulated, they will be tracked, and you will have to make those changes when the next forecast is open for changes, right? That is what the term they use. Okay, they will say, okay, this is end of week 1 of April. Now the forecast is open for updates. Okay, when you have the forecast open for updates, meaning you can make changes, and during that window only you can make the change. Okay, so once the forecast is updated, you cannot make, usually you cannot make change unless you have an exception or an approval from the CFO.
So
And
I'll just add
yeah,
one point on
yeah.
this. Usually what happens is that the forecasts get locked
Mhm.
after multiple levels of approval. So usually the one who's kind of preparing the forecast, he will promote it to L1, and then L1 is your manager. He will review it. He will then promote it to L2, which is usually the FP&A lead or the CFO. And once the FP&A, once the L2 approves it, right, then it is hard to change. Then probably unless it is something extremely major, you won't necessarily change a forecast.
Absolutely. And does it mean that you don't have to track your numbers or you don't have to keep a track of your assumptions after the forecast is locked? Absolutely not. So any changes that happen after the forecast, you have to keep a track of it. You have to keep a log of it, of those assumptions. And just in case if there is going to be a big change, right? If there's a big change in assumption which is causing a big change in revenue or a big change in expenses, you may also want to flag it off in something we call this as a risk and opportunity management report. Okay, this one uh, Excel tracker that you maintain, which is called as a risk and opportunities tracker. And anything big that has changed after the forecast, you may want to decide, okay, if this is big enough for the CFO to know, or if this is big enough for the CEO to know. Okay. And if it is, it might be very few items that are right. You may want to just flag it off to the CFO. You might send a risk and opportunities update maybe at the end of week 3 or week 4, whenever once in a month, or whenever you have those items, or whenever at different intervals. That is what you do after the forecast is locked. Okay, so one is that you don't stop tracking the assumptions. You keep an eye on the assumptions, but you keep documenting it. It will not be changed in that version of the forecast. It will get pushed to the next version of the forecast. But if anything material has changed, you may want to flag it off as a risk or an opportunity, depending on the type of that. Type of that changes. Okay, so let me go to the next FAQ. In the meanwhile.
Yeah, the next question is, what are the key steps to ensure the accuracy of the forecast? What are some of the checkpoints? What are the hygiene points that we need to keep in mind?
Yeah. This is what A lot of people also ask, how do you make sure that the forecast is accurate, or how do you make sure that the forecast is right is as close as possible to the actuals that are going to come. Okay, so first thing is that you cannot be, or you can never be 100% accurate. The objective of the forecast is not to be 100% accurate. However, it doesn't mean that you can be like off 10, 20, 30%, right? So typically you want to ensure that you want to try that you get as close to the actual numbers as possible, but also remember that you will never be 100% accurate. You might always be some percentage points off, right? That is why it is a forecast, right? That is an estimate or an guess that you're doing, or some sort of an estimate that you're doing before actual numbers are available. So one is that it'll never be 100% accurate. Having said that, you should at least try to get as close as possible. So what has helped me in my previous roles is that whenever the actual numbers are available, right? We saw that in the calendar, right? When you update the forecast in week 2, in the next month when the actuals are available, right? So once you have updated the forecast for the remaining 9 months, I'll just go back to the calendar to maybe demonstrate this. So let's assume you have updated the forecast here, right? So this is say the month of April, and you have updated the forecast for, you've updated the actuals for March, and you've updated the forecast for April to December. Okay, now when you come to the next month, which is month of May, right? Here now you will have the actual numbers for April, right? Which you had forecasted in the previous month. So here you are doing some commentaries on management reporting, and you are doing the analysis of variances between what happened, why your forecast was different from the actuals. Okay, so while you're doing those analysis, you will figure out the reasons. Okay, it was different because one of the assumptions I made was not correct. Okay, because one of the drivers that I had assumed was different from what. So when you do that analysis on a monthly basis, which is the variance analysis, which is another big part of FP&A role, you will automatically know where you went wrong in the forecast. Okay, and you can also keep a track of it in terms of how accurate your forecast is. Meaning, was it 98% accurate, or was it 95% accurate? And when you do this on a monthly basis, when you do this variance analysis, when you do the root cause analysis, when you do the 5i when you use the 5i technique and you get to the root cause of the analysis, you will know which drivers are the most important drivers. So after you've done this for maybe 2 or 3 months, you should be able to identify, okay, these are the 4 or 5 drivers that is affecting 80 or 90% of the forecast. Okay, once you've identified which are the, what we call it as the key drivers, then your focus should be on those key drivers, because if you get those key drivers right, then your forecast accuracy will automatically improve. So what in just to summarize, you have to make sure that whenever you do your monthly commentaries, which is actual versus forecast, you identify the root cause. You also identify what are the drivers that impact, right? What are the 80 what are the 20% of the drivers that impact 80% of your forecast outcome, Okay, once you identified, okay, these are the 3 or 4 most important drivers that is impacting 80-90% of the forecast. And in usually most cases, there will be 2 or 3 or 4 key drivers that are very important. In that case, once you've identified that, in your next forecast, when you update that, you have to make sure that you pay most attention, or your majority of time should go on making sure that those assumptions are updated on a most accurate or the best possible basis, or you go very deep on those key assumptions. Okay, so that is on how to get your forecast. So it's not going to happen uh, overnight. So you will require to spend 2-3 months understanding what is the variance, identify what are the key drivers, what are the drivers that is causing the most impact on your outcome. Once you identify that, and then you do the next cycle, you make sure that you focus on those particular drivers which are giving you the most impact on your outcome. Okay, anything you want to add, Dhaval, to that? Let me stop sharing my screen.
So one thing I would like to add is that when it comes to the accuracy, what is important for a forecast to be right is that we need to be directionally right, right? Nobody expects the accuracy till the last dollar or cent. As long as you're directionally correct, you're not grossly wrong in terms of the business direction that you want to take, right? Forecast is good enough, right? So uh, is nobody will blame you for not getting that 100% accuracy. While it is desirable, but as long as you're directionally correct, you should be okay. Okay, fantastic. So now that you have some understanding of the financial planning and analysis function, now that you understood what is a budget, a forecast, a rolling forecast, right? So one thing that I've always noticed is that FP&A is an in-demand skill set. 79% of the CFOs that I spoke to, or we did a CFO survey, they said that it is generally difficult to find the right FP&A talents, which means there's a lot of demand, but there are not enough skilled professionals out there. So anything that you want to, grab that opportunity in FP&A, you will need to invest in learning about FP&A. And the CFOs, after speaking to dozens of CFOs, we have identified 5 critical skill sets that CFOs are looking for in the finance professionals for today. One is core FP&A concepts. Your budgeting, forecasting, management reporting, all of these things are non-negotiable, right? So they are looking for that commercial knowledge. Financial modeling. How do you build sound financial models, revenue model, cost model, scenario planning, sensitivity analysis, all these core concepts of financial modeling, specifically related to FP&A is what we are looking for. Data storytelling. How do you communicate your insights to the business teams? They don't understand Excel sheets. They don't understand a long charts and tables, right? So it's important how effectively and precisely you can communicate your data story to the business teams. Business partnering. Today, you're expected to act as a business partner. You're expected to act as a coach, which means that you will need to develop business acumen. You will need to understand how do you build stronger relationships with cross-functional teams. All that is important when it comes to business partnering. And of course, technology. Technology is fast changing. Everybody is now leveraging AI for finance and FP&A. So you will need to be a tech savvy professional, understand what's happening in the world of AI and generative AI, and then adapt yourselves to become a tech savvy finance professional. So all these core 5 skill sets that we have identified after speaking to hundreds of CFOs, right? What we are doing at FPI is that we are giving you a learning path that will help you equip yourself with all these 5 skill sets, right? And we are doing it through live sessions every week. All you need to spend is 2 hours, right, with us through different live coaching sessions, where we'll share with you 100% practical case studies, whether it is examples, cases, all of them are based on the experience that Asif and I have gained and our other instructors have gained. Right? You will also get certified by FP&A Professionals Institute. There'll also be monthly Q&A sessions where we answer any questions that you have. We typically bring in guest speakers, CFOs, FP&A leaders, tool providers, many more to help you kind of keep updated with all the things that are going on in the FP&A world. And then you'll of course get access to all our FPI global community, where we keep posting jobs, where we keep posting about all our updates, course updates, where you can talk to each other as a community, in a very helpful community that you can be part of. Now, all these things, you must be thinking, how much time will it take? How much cost investment will it take? But trust me, all we need is a commitment of 2 hours of your time on a Saturday. And we have designed all our courses for busy executives like yourselves. And all these critical skill sets that I just spoke about, we have bundled them in our pro plan, which gives you access to four different courses. One is your FP&A Masterclass, which covers all the basics about FP&A, budgeting, forecasting, data storytelling, business partnering. Then financial modeling for FP&A, just the right skill sets that you need for FP&A. All those financial modeling skill sets are captured in this particular course. AI for finance and FP&A, how do you leverage Gen AI tools, Copilot, ChatGPT, Gemini, all of those things are covered with use cases in our program AI for finance and FP&A. And all these have successfully done multiple batches. FP&A Masterclass has done more than 16 batches. Financial modeling is undergoing a 10th batch as we speak. AI for finance is in its 4th batch. And then there is Finance Leadership Masterclass. End of the day, at some point in time, you will graduate from being an individual contributor to a solid team leader. And that's your first step towards becoming a CFO or a finance leader. So I have curated a program for finance leaders to help you upskill yourself with your leadership skills, team leading skills, and how you manage your expectations of your stakeholders, right? Because when you become a leader, your team will come to you, your employees will come to you, your team members will come to you, your boss will come to you, right? So how do you manage all of those things are captured in Finance Leadership Masterclass. So a bundle of all these courses, plus access to all our workshops, boot camps, everything that we keep conducting on a regular basis for $297. And we'll share a personalized learning plan with you, where we will give you a calendar. Every month, you need to take up one class, could be masterclass, or it could be stage that you are at. And then throughout 2025, you will be covering all of these classes live with us and upskilling yourself on these aspects. Don't just take our word. There have been dozens and dozens of testimonials. Hundreds of students have now been benefited through all these courses. Many of them have been able to transition to FP&A roles, which is amazing. We have plenty of case studies. A lot of success stories are available on YouTube as well. You can just go and search for them. Here's a quick schedule of our upcoming live programs. In February, we are now starting with two main programs. That is FP&A Masterclass, which starts on 8th of February, right, where it is all the core concepts of FP&A. And then there is Finance Leadership Masterclass, which is on team leading. That starts on 9th of February, which is Sunday. So Saturdays, 8 a.m. to 11 a.m. and Sunday, 8 a.m. to 10 a.m. IST. And then in March, you will get equipped with the other courses, which is AI for Finance and FP&A, which again starts on 8th of March. And then Financial Modeling and FP&A, which starts again on 9th of March. So this is the schedule for the next Q1 of 2025. So typically, you can expect that between now till end of April, you will be equipped with all those 5 skill sets, core skill sets that I spoke to you about, which CFOs are looking for in their teams, right? So that's the quick schedule of our upcoming programs.
I just wanted to add, if you can go back. So these are the start dates of the programs, and all the programs are 4-week programs. Okay, so they'll continue for 5 Saturdays or 4 Saturdays or 4 Sundays from the date they start. Typically, most programs are 2 hours on Saturdays, except for Masterclass, which is a 3 hour on a Saturday. So yeah, these are start dates, and typically all the programs will run for 4 weeks, in anywhere between 2 to 3 hours on either a Saturday or a Sunday.
Amazing. We also have our detailed advanced program called Certified Global FP&A Professional Program, which is a 6-month exhaustive program, 100 hours of content, has a capstone project, an examination, all of those things, right? So it's a detailed program. And the next cohort of this program starts on 22nd of March, 2025. This is only as per application. So if you are interested, please DM us and we'll send it to you the application link. This is not for everybody. We would recommend that if you still haven't started on your FP&A journey, go with the membership. If you have not if you're already in the FP&A profession or just recently started with your FP&A journey, then go for Certified Global FP&A Professional Program. So that's what we would recommend. Happy to take any questions that you might have now about the training that we conducted today, about FP&A career in general, anything that you might want to ask. Feel free to raise hands, unmute yourself, and then ask questions. All the detailed links have been shared in the chat box. We will also be posting them on the WhatsApp group, and you can subscribe to them. And hopefully, we will be able to see you in one of our classes.
So what I've done is I've posted 2 links in the chat box. One is the FP&A bundle link, which you can go and choose the pro option. So if you're going to go for the live classes, so there are 3 options there, which is basic, plus, and pro. So basic is free. You can just go in basic and you can get 1 or 2 courses, which are foundation courses, and one of my books, just free of cost. So even if you're not going to join now, you can just enroll and become into the basic plan, and you can get the benefit of the Foundations program and the ebook. The Plus program is a self-paced program, so you get access to a couple of programs which are FP&A Masterclass self-paced version, okay, and a couple of other recorded programs. So you get access to the recorded programs in the Plus, and in the Pro, which is what we talked about just now, is are all the live programs.
While you're thinking of the questions, one thing that I would definitely, encourage you all to think about is that, when Asif and I started, we did not have any kind of support, right? So there was no LinkedIn, there was no online learning revolution that is going on today. There was no community help. All we did was, learning through a lot of errors, trial and errors. And if our bosses are in a good mood, they will teach us. If not, then we do our share of mistakes and learn them. But today, fortunately, online training programs. So take use of this, take benefit of this. And we're happy to share that we have students from more than 45 countries who have taken courses from us. And we're incredibly proud of our students for what they have achieved, with a little help, of course, from us, but I wouldn't take the full credit for it. They have been, the first step that you always have to decide is to, make a decision, right? So if you're not allocating at least 3 to 5% of your annual income in learning new things that are going on out there, in learning new topics, then how will you compete against others? So ask yourself these questions and then take your decision, right? And Asaf and I are always available on LinkedIn. If you have any questions, you can, of course, DM us, reach out to us, and we're happy to take your questions.
All right. Thank you so much, everybody. Thanks for joining, and we will see you in one of the trainings or one of the future webinars. Thank you.